Hey, I'm Charlie Mattingly with Leading Edge Financial Planning, and today I've got our newest advisor, Rob Eklund, with us today. We're going to talk about kind of what you see on the screen. What a crazy year it's been. We're going to look back a little bit, Rob, talk about things that, ways you can prepare for stuff like this, ways you can't prepare. I mean, what a phenomenal year. And it's been sometimes, and there's been a lot of tragedy, obviously. So we're going to take a look at the investing side of the house today, Rob, and see if we can get some lessons learned out of this so we can become better investors and better prepared for our retirement.
Hey, that sounds good, Charlie. Good to be here. And yeah, what a roller coaster year it's been so far.
Yeah, absolutely, man. And, one thing I was talking about, Rob, is that, you're a pilot for Southwest. You're been a military pilot. I was also a military pilot and now a previous pilot for Southwest. But it's interesting how we compare and have these analogies, and one industry steals from the other. And I think it's in fact, I think the pilot world sometimes steals risk management strategies from the investment world, because flying an airplane really is all about risk management. But Rob, I mean, what do you think? Like, if you're preparing for a mission, you don't know what this mission holds. How do you prepare as a pilot that we can learn from, as investors and people that are trying to plan for retirement? And what do you do? What do you think translates from one profession to the other?
Yeah, that's a great question, Charlie. Quick disclaimer, I am a pilot for the Air Force and for Southwest, but I've got the beard because I'm a reservist and I haven't worked for Southwest since I'm on the extended time off. So that's the only
Yeah.
reason I have the beard. Otherwise, I wouldn't have it. But
Yeah.
yeah, as far as flying and how some of that translates over to the
Mm-hmm.
investing world, you prepare, right? You
Mm-hmm.
prepare for what's going to happen. You look at the weather, you look at what's called notices to airmen, you look at
Mm-hmm.
takeoff and landing data and all these different things to make sure you're prepared when the unexpected, which is actually expected in the flying world, comes up. When you're investing, the same is true, right? You don't know what's going to happen, and just knowing you don't know what's going to happen prepares you for when the inevitable does happen, which is COVID-19, 9/11,
Mm-hmm.
World War II, World War I, Vietnam. All these different things happen, and the market continues to go up. So find comfort in that, and just be prepared. Walk yourself through. Hey, what happens if we have riots in the streets? What
Mm-hmm.
happens if the guy I don't like gets elected
Mm-hmm.
president? And if you
Yeah.
walk through those scenarios and you look back at history, you're going to be comforted with the fact that the market's still going to continue to do some pretty good things.
Yep, that's awesome, Rob. I love it. You talked about a lot of good things there. I love historical perspective. I think it's not the answer. It doesn't predict the future, but it sure helps us to have a perspective. And I love the analogy, and maybe it's more than an analogy. When we literally steal from these industries and each other's industries, plan and use them. And I love the idea of being proactive. In the financial business, there's this ongoing debate, and it's really specifically about how you invest. Are you active? Are you passive? I hate the word passive. You know what I mean? And there really is, I mean, it's really all gray. There's a lot of in between, but I like proactive. Exactly what you just said. We plan for these things and we understand. I love what you said. You don't know what's going to happen. You have to first start with that, because the best investors in the world are going to go, we got to plan for the unknown. We got to prepare to be wrong, quite frankly. And sometimes I hear people say, well, this is going to happen. And I have to say, no, I don't know that. And so we got to prepare. What a crazy year. But one of the things, one of the ways to prepare is diversification. This, Rob, is almost a cliche. That's boring. People don't like diversification or talking about it because you kind of feel like like you don't know. People like to be negative. I read the other day, because it gives them a position of authority. This negative thing is going to happen. Therefore, I have authority, and I don't know. So we've got to diversify. Diversification wins, Rob, in the long term. And this slide from BlackRock sums it up perfectly. You never really feel that great. In fact, one of the things says, you're properly diversified when it feels like you get a kick in the stomach every year, because you're either missing out on something, something's done better, whatever. But in the end, you can see the number down here. This is for the last 20 years. This is a study from BlackRock. and it wins in the long term. So that's one of the things that we think about as far as diversification is concerned. One of the ways
Uh,
to be proactive.
Absolutely. That's a great
Mhm.
slide you have there, Charlie, for
Yeah.
sure.
Yeah, we've got a bunch more. We're not going to do an hour-long presentation here, but we've got a lot of things to talk about as far as just strategies, and we will try to make it as exciting as possible. But one of the things too, Rob, is like you try to be proactive. Again, not passive. We plan ahead, just like on the flying missions. We get ready for the weather, emergencies, maintenance problems, and we're prepared for those contingencies. And sometimes by preparing, we can avoid them. Sometimes you can't. But like this past February, March, April, Rob, these are a lot of the things. This is from Vanguard's website on, hey, you don't have to do nothing. There's a lot of things you can do. Here's a lot of strategies that you can do. Rob, a couple of things that you and I talked about was, during the downturn in March, we were looking for opportunities for Roth conversions. You can convert now Roth. If you convert those holdings, you're going to convert the same amount of holdings with a lot less tax implication because the values come down. You can do tax loss harvesting, which can be a very valuable strategy. And oh, by the way, it gives you a chance to reevaluate where you are, your risk tolerance, risk assessment, et cetera, and rebalancing, along with a lot of the things on this slide. So there's a lot of things you can do. Unfortunately, Rob, as you know, once the downturn starts, you don't want to be reactive, just like in the flying world. You don't want to be reacting as you're approaching a storm. You need to have that game plan ready to go in your mind.
Right, exactly. Yeah, and then just along with the theme, you have those off the shelf plans. Hey,
Mm-hmm.
when something goes wrong, when a COVID pandemic hits, no one can predict, or something hits,
Mm-hmm.
because something will always happen, as you saw from the previous slide.
Yeah.
You know what to do. You're going to rebalance,
Yeah.
dollar cost average, or monthly invest through it if you can, and
Yeah.
at some point, you might even think about being greedy when others are fearful,
Yeah.
if you can be in that position.
That's right. Yeah, absolutely. And it really, Rob, it really kind of always boils back down to this boring things. Like I gotta have some bonds. If I'm nearing a retirement or I don't have the years to be greedy, like you said, maybe I'm closer to retirement. Well, I've got to be proactive and have some of those bond holdings that will help me, that will help limit my losses. This is an example, Rob, of a real client, and they went down significantly in March, but they didn't go down as far as the market because there were some other strategies there that helped limit that downturn a little bit for them. They're a little bit closer to retirement, but they stuck with it, Rob. It was really hard to do. I mean, looking at the first slide, and they stuck with it, and it wasn't easy, and there was a lot of unknowns. But we said, hey, look, we're prepared for this. We've been proactive. We've planned. We know your time horizon. We understand where you are, and we stuck with it. And now they're up a little over $100,000, on a diversified portfolio. So, so that's exciting to see that. Now we're not out of the woods yet, Rob. I mean, we've got some things to face going forward in the next year or so, and we'll be prepared for that as well. But this is what it looks like when, unfortunately, these are very similar profiles, very very similar amounts of money, exact same time frame. But this is what it looks like, Rob, when maybe we're not confident with the plan and we tend to change course or, quite frankly, bail out at the worst possible time. This is real money, Rob.
That's tough. That's tough
Yeah.
when you have that kind of situation where
Yeah.
you may bail out, and that's one of those things. If market timing doesn't necessarily work at all, or it doesn't
Mm-hmm.
work, as Jack Bogle used to say, he's never met anyone who's been able to consistently time the market, and he's never
Yeah.
met anyone who's met anyone who consistently can time the market. So this just
Mm-hmm.
addresses that. You have to be right twice if you try to market time. You have to be right the
Yeah.
first time when you get out, and you have to be right when you get back in. So
Yeah.
this is a great example of
Yeah.
that.
Yeah. This is a real life scenarios, and it kind of, quite frankly, it sucks, that this is very hard to recover from once you've missed. And we've seen the statistics, Rob, where the best days in the market come in short little spurts, and if you miss those, if you're out of the market, then it's hard to get that back.
Well, that's a
The,
great point. Just real
Mhm.
quick, Charlie,
Yeah.
if you missed out on the best 10 trading days of the years following the 2008 crash, you missed out on 50% of the upside. So
Yeah.
you really want to make sure you're in during those 10 days.
Yep. You got to be in the fight somehow. It doesn't have to be 100% stock,
Right.
but you got to be in the fight. And so here's the interesting thing, Rob. I mean, this example investor gets out of the market. You would think they'd be able to take a sigh of relief. I'm out of that. I'm off the roller coaster ride. I'm out. Well, that's just the beginning. The stress is not over. In fact, I think there's more stress if you do that, because now you've gotten out, and now what do we do? We're off the rails, Rob. We don't have a plan there. And I will tell you, uh, there's no magic signal for getting back in. In fact, this is what it looks like. This is a cutout from the very first slide we showed. And Rob, I asked you, I said, look at this slide. When do you get back into this thing? Do you get back in when the riots are going? Do you get back in when there's a presidential election? Do you get back in when oil goes negative for the first time in history? I mean, there's some weird things, but the stock market was going up. We even had a bad September that looked, I think we lost 7% in 7 days in a time stretch in September. When is that when you're going to get back in? I mean, there's no easy way to do that, Rob. It's very challenging.
Oh, exactly. Yeah, just looking back at this year alone, you can see that. And looking back at all of history, it's not just this year. You could go back every year practically and see similar type details. So you're exactly right, Charlie.
Yeah, that's fascinating. And we don't, I don't want to criticize anyone for, what they've done, but this scenario, this year has been so unprecedented, Rob, that you can't blame people for thinking, hey, there was talk in March, like we're headed for a Great Depression, and we very well could have, we don't know. And still, unfortunately, sadly, people are still dying. We've not gotten out of the woods yet. Looking forward though, Rob, all right, we've learned a lot looking forward. So now what do we do? Well, we're still in a world of unknown. The markets are unknown. The economy is unknown. We're not out of the woods. There's some things down here. This is a slide from New York Life. They've put this together, and this is, again, a cutout from that, but they've talked about worst case and best case, and anything in between can happen. So again, we got to go back to the fundamentals that we've talked about, and the things that we can do to be proactive and be prepared. But that's why we get paid. And that's why there's a return, Rob, is because there's uncertainty. Your investments are going to go up and down. If that didn't exist, there would be zero return in the markets. So that's what you get paid for.
Exactly right. And it's so nice to have someone who does this for a living, obviously, but also, just having a buddy to walk you through and bounce ideas off of, and be there to go get through these hard times. Because even the best of us, when COVID hits, you start thinking of different things. But if you've got that rock there by your side that's able to walk you through it, and your buddy with you, you get through it much easier.
Yeah, trusted advisor. I mean, that's one of the values that we hope we bring at Leading Edge is just being that sounding board and that trusted team around you when things get crazy. So, I kind of put this slide in last minute, Rob, because, now we've got people like, hey, I've been out of the market. I can't get in now. We're at all-time market highs. It's a bubble. We got a bubble. This is from March 2012, Yahoo Financial News, actually CNN money.com, it looks like. And 2012, Rob, we're talking about a bull market entering the fourth year. And clearly you can see right here, there's a strategist says the S&P is set to fall 15%. Don't get back in this market now. It's too high. Now what are you going to do, right? It's too high.
Right. Right. Yeah. So they're there to sell viewerships and clicks and that kind of stuff, not to manage your money.
Yeah. There's always a reason not to invest. So Rob, we're going to finish up real quick with 10 steps that people need to remember to fall back on when things get going crazy. COVID, like you said, September 11th, and the next event, whatever it may be, if we can stick to these 10 things and remember these principles, we're going to be okay. And again, it's being proactive, like you talked about. Number one, understand the market in the long term is very efficient. There's 98.6 million trades per day, the daily average anyway. So the prices the pricing in the stock market, the way we purchase things, very efficient, meaning you're not going to outguess this market. That's number two. You're not going to outguess it, so sometimes we get caught trying to be too fancy, too smart, instead of relying on the fundamentals, which we know to be true in all circumstances. Number three is, past performance. Everybody wants to buy yesterday's top hits, and that is also a recipe for disaster, because inevitably those best performers from yesterday or the last several years are not necessarily the worst, but they underperform the market going forward.
Yeah, that's a great graph there, Charlie, and the previous slide as well. There's a saying that if you're trying to find the needle in the haystack, if you're trying to find all these just one line stocks or one company to go with, but you're trying to find the needle in the haystack. But if you own the haystack, you're going to get the needle.
That's right. It's almost we almost have to simplify our thinking. Complexity sometimes is the enemy of success in the investing world. And that's kind of talks to number four. Hey, let the markets work for you. There's history to be our guide, and we're going to use that to develop our investment process. Number five, where do returns come from? Rob, we at Leading Edge, we have a very specific investing philosophy that says this is where markets come from. This is from dimensional fund advisors. We use a lot of their investments. And of course, as you see at the bottom, that doesn't mean they're always going to perform well. They're going to have some bad years and some good years. But the evidence has shown over time that these are where returns, premium returns can come from. So that is possible. But again, nothing here is predictive, and there's definitely a lot of unknowns still, even knowing where they come from.
Yeah, a lot of unknowns out there.
Yeah. So again, we've talked about diversification, avoid the market timing, and understand, Rob, like you talked about early on, that, hey, this is an emotional battle, and we've got to understand and know ourselves and know that it's very difficult to tell between, am I making an emotional decision or a decision based off of market fundamentals, especially in the short term, because quite honestly, Rob, I've compared the stock market in the short term to like a crazy person. It's just reflective of our own psychology in the short term, and good luck guessing at what that's going to be. So yeah, 9 and 10, to wrap up here, just avoid the headlines like we showed you earlier. It was a bull market ready to it was a bubble bull market according to the headline in 2012, so it shows you how reliable that is. And finally, focus on what you can control. That slide we showed in the middle, rebalancing, tax loss harvesting, diversification, those boring principles are what's going to get you through these types of situations. So, Rob, I've talked a lot. Hopefully this has been value, but what do you think, man? Anything to wrap up here and finish up?
No, I just think you're hitting the nail on the head here. If you keep just being methodical, much like we are in the flying world, when you go through a planning scenario, you're being methodical about this. And when you think about what can happen, obviously we practice for that a lot, but you can do that even in the investing world, not knowing what's going to happen, but knowing something's going to happen. And that's just going to help you get through these scenarios a lot easier, and is frankly going to just put money in your pocket down the road.
Yeah, absolutely. Well put, Rob, and thanks for hanging out with us today for a few minutes. Please reach out to us anytime, leadingedgeplanning.com, and we're out there on LinkedIn and Facebook. You can find us there as well, or Rob and I are happy to take an email from you. Mine is charlie@leadingedgeplanning.com. Rob is actually robert@leadingedgeplanning.com. So feel free to reach out. We'd love to hear from you. Thank you very much.
Hey, it's my pleasure, Charlie. Take care.
All right.